Once upon a time, today's stock market giants, including Apple and Nvidia, were small caps that most investors overlooked. So today, I'm sharing four small caps with the potential to be tomorrow's market leaders. Each earns a top rating from our proven quant model and has a powerful catalyst driving growth right now. Be sure to stick around to the end because the last stock pick has a very appealing characteristic I almost never see in a company this small. Now, before we get rolling, do me one quick favor. If you like stock insights like this, then tap that like button. It's the single fastest way to tell YouTube to put more quality stock analysis like this in front of you in the future. Now, I want to dig in with our first pick, and that's Proto with the symbol PRLB. Now, before I get going, just a quick reminder that investing carries risk. Always do your own due diligence before investing. Now, I should probably tell you who I am. I'm Steve Reitmeister, but all my friends call me Righty. I spent nearly 20 years the editor-in-chief of Zacks.com, and today I'm a partner at WallStreetZen, where a quant rating system analyzes a wide array of data points to separate the best stocks from all the noise and nonsense. All right, speech over. Let's get back to those stocks. Proto is one of those companies working quietly behind the scenes of American manufacturing. If a company needs a custom part fast and a prototype, a small production run, then Proto is the right company to call. Now, you upload a design, and their factories turn it into a real physical part in a matter of just days. So why does this matter right now? Two words: reshoring and speed. Because of the terrorists, companies are pulling their supply chains back home, and that shift is creating more demand for fast, flexible manufacturing partners like Proto. This is reflected in the fact that the company just closed out its best year ever with record annual revenue. Now, management is calling this a pivotal year of transformation for the business that sets the stage for even more growth ahead. Right now, Wall Street expectations call for more than 3 times more growth than the average stock in their industry. Now, further, the data says that the stock is also a great value. Consider the average stock has a price to earnings growth ratio of 1.5, so anything under 1 is a screaming value. Yes, Proto is trading in under 1 on the PEG ratio, which makes it a compelling value at this time. Now, we will put the stock under the microscope of our Zen Ratings quant model. All in all, we review over 4,600 stocks across 115 different fundamental factors to find the best opportunities. Then we apply an intuitive letter grade of A to F. Indeed, Proto comes in with an A rating, which amounts to a strong buy recommendation. That's because it scores in the top 4% of all stocks tracked across those 115 fundamental factors. Underneath that overall rating are 7 component grades, each one scoring a different aspect of a stock's attractiveness. Here we find a lot to like. We're in the top 14% of all stocks for financial strength, and top 12% for both growth and momentum, plus top 6% for both safety and sentiment. Proto is a well-positioned company that has completed a turnaround that is starting to flex some muscle on the growth front. On top of that, we see a special Zen Ratings profile that boasts strong financial footing, timely price action, with the smart money starting to lean in. What's not to like about that? Before I continue, if you enjoy discovering high conviction stocks like these, then you can get even more by joining me every Monday at 7 p.m. Eastern Time. That's when I host my weekly live training sessions with timely market insights and top stock recommendations. Now, it's totally free, but you do need to register now. Just go to wallstreetzen.com/live. Okay, the next company took a very public faceplant and then quietly clawed its way back. Heck, you probably own some of their products. I'm talking about Sonos with the symbol of SONO. They make those sleek wireless speakers and soundbars in living rooms everywhere. This is one of the most recognizable names in the audio entertainment space. Now, here's the turnaround part. Now, back in 2024, Sonos rolled out a new app that was an absolute disaster. The stock got taken behind the woodshed. Since then, they fixed the app and fixed their business. That spells opportunity for investors before everyone else catches on. The best proof of the turnaround is showing up in the accelerating earnings growth that is currently expected at 45% a year, more than 4 times higher than their industry average. Wall Street coverage on Sonos is thin, but the one analyst on board ranks in the top 4% of all analysts for his stock-picking prowess. That's Steve Frankel of Rosenblatt, who recommends it as a strong buy, with a price target calling for 50% upside potential from current levels. Again, Frankel has the kind of track record that makes many investors stop and listen. Now let me forge ahead to our own data, because this is where Sonos really makes its case. The Zen Ratings gives Sonos a solid B rating, which is a buy recommendation based upon its impressive fundamentals, ranking in the top 8% of all stocks we track. So maybe B plus is a little more accurate. By the way, the Zen Ratings are updated every single day, so you can pull a free rating on Sonos or any other ticker just by typing the symbol in at WallStreetZen.com. Be sure to bookmark it now for frequent future visits. There's a lot to like in the component grades for Sonos Sonos as well. It scores in the top 32% of stocks for sentiment. That's the smart money indicator. Top 22% for financial strength, and top 9% for artificial intelligence factor, which sniffs out price patterns that tend to come before a big price move. Now, the standout grade here is growth, where Sonos ranks in the top 3%. That is the best predictor of future earnings beats. I should also mention is the #1 rated stock in the entire consumer electronics industry. This tops names like Sony and Apple, so kind of an impressive way to shine in that group. Investors often don't trust a turnaround immediate, so Sonos needs to prove this recovery is on track one quarter at a time. If they can do that, then these shares are set for a serious outperformance. Quick ask before we move on: if you're getting value out of this stock breakdown, then hit subscribe and turn on the notification bell. I publish data-driven stock analysis like this every week. Bell is what makes sure YouTube actually shows the next ones to you. Speaking of things you want to see, let's talk about a stock offering a truly unique opportunity right now. That brings us to the Orion Group with the symbol ORN. They're a heavy construction outfit. Simply, they're building the infrastructure that holds up both the coastline and the digital economy. Now, on one side, they construct docks, ports, piers. On the other, they pour the massive concrete foundations that data centers are built on. The latter, in particular, has become a major growth driver for the firm. Now, here's a mismatch worth noting. Orion has a market cap under $600 million, but management says it's pursuing a pipeline of opportunities worth $24 billion. Yes, billion with a B. That opportunity absolutely dwarfs the company's current size. Now, when a business this small is fishing in that big of a pond, even landing just a fraction of that work can truly transform the company and, yes, its stock price. Between the reshoring boom and the explosion in data center construction, Orion appears to be standing exactly in the right place at exactly the right time. The opportunity is already showing up in their forecast. Orion's earnings are expected to grow by roughly 65% a year going forward. That's about 5 times the pace of the average company. Now, Wall Street has certainly taken notice. Orion carries a strong buy consensus rating. Even better, 2 of the covering analysts rank in the top 2% of all analysts for their stellar stock picking track record. One of them, Brett Thielman of Oppenheimer, is pounding the table for 40% upside to fair value in the year ahead. Once again, the Zen Ratings quant model favors these shares. The A rating is born of its fundamental profile, scoring the top 5% of all stocks. Underneath that A rating are these impressive component grades. Now, we're talking about top 12% of all stocks for safety, top 9% for momentum, and then the crown jewel, the top 3% of all stocks for growth. That is about the consistency of growth, which often foreshadows even more growth ahead. Growth and safety are often at opposite ends of the investing spectrum, so very special and appealing to get both in the same stock. The honest trade-off here is the balance sheet. Heavy construction is capital intensive. It's a lumpy business, and Orion carries real debt to fund that work. But honestly, that's a pretty low price of admission for a company taking such a big swing with their business pipeline. Again, even just a small fraction of that coming true sets up the stock for a monster ride. The strong Zen ratings and Wall Street support further increase the odds of this more speculative bet paying off. But my final pick takes that idea even further. Now, if you made it this far, then I'm guessing you're getting some value out of this video. Thus, I want to give you even more value by personally inviting you to my next live training session. I like to kick things off with a timely market update, plus my investment plan to outperform. Then I finish up strong with my trade of the week, combining the best of the Zen ratings with my greater than 40 years of investing experience. Now, it's totally free, but you do need to register for this coming Monday at 7 p.m. Eastern Time. Just go to WallStreetZen.com/live, or click the link down in the description, or scan the QR code on the screen. I look forward to seeing you this Monday. Now, for that final pick on the list today, we're talking about Motorcar Parts of America, MPAA. I saved the smallest company for last on purpose. Now, with a market cap of around $270 million, it's by far the tiniest name we'll cover today. On the surface, nothing that exciting. They are a remanufacturer of auto parts, alternators, starters, brake components. They're taking worn-out units, rebuilding them like new, and then selling them back into the repair market. Therein lies the tailwind. Americans are holding onto their cars longer than ever, and thus there is a larger fleet of older cars which need more repairs, and that's exactly where Motorcar comes in. On top of that, the company just acquired Centric Parts, brake brands, out of bankruptcy, expanding its presence into the braking market. Now let's flip from braking to acceleration, as in this company is enjoying a serious turnaround and acceleration, going from nasty losses back into the plus column. The growth acceleration is real. Right now, Motorcar's earnings are forecast to grow by nearly 50% a year going forward, far, far faster than their industry peers. But here's the thing that makes this one special. Look at what you pay for that growth. That PEG ratio here is under 0.5. Remember when I said earlier the average stock has a PEG ratio of 1.5, so this is dirt cheap, especially given the tremendous growth prospects on the horizon. The last part is the main reason this tiny company closed the show today. Also helping the case for Motorcar is their stellar Zen ratings profile. Once again, we have an A-rated stock pointing to a strong buy recommendation. All in all, it's in the top 3% of all stocks across that 115-factor review. That is the highest overall grade of any of the stocks on the list today. So what do the component grades say? Now, Motorcar scores in the top 13% for growth. Here again, that's about the consistency of growth and the likelihood of more beats ahead. Top 12% for value and top 11% for sentiment. This combination reflects real growth, a genuine value price, and the fact the smart money is already leaning in. That is a rare and very appealing trio to find in any small stock. And yes, a company this size will have a bigger price swings than your blue chip stock. So you do need to stomach that extra volatility. But that tiny size also means there's a lot of room to grow into something several times larger, especially as the growth story unfolds and investors start properly bidding up shares. So there you have it. 4 small caps that can be planting seeds to grow into tomorrow's large caps that everyone's talking about. Now, I want to hear from you. Which of these 4 is your favorite? And which small cap am I missing that deserves to be on the list today? Drop a note in the comment section below and let's talk about it as a community. And if you're not sure what to watch next, then I suggest you check out the video that's popping up on your screen right now. In that one, I broke down the top 4 AI stocks that I'm eyeing right now.